Good afternoon, everyone, and welcome viewers to this edition of Centrum Finverse webinars, where we connect our investors and potential investors to the best of investment intelligentsia, which then would enable them to take better investment decisions. The objective is to bring to our investors the perspectives of various market experts. And in this series of webinars, we have a very special one today, where we're going to touch upon a point which is there on everyone's mind. And we have an expert with us to address that topic and also answer your queries. And I am Arun Gopalan, your host on Centrum Finverse webinars. I head the research desk at Centrum Finverse. And the topic which we will be discussing today is something, as I said, is on everyone's mind, which is generating alpha at times when the markets are turbulent. A very difficult question, but everyone wants it. It's like that which everyone earns for, but very few actually manage to get. And our guest for today is one who specializes in doing that. And I'm very glad to introduce you to Manish Jain, our head of fund in the Centrum Group. He heads our PMS desk, has rich experience in handling portfolios, and has performed spectacularly in the past. And so, Manish, welcome to CFL webinars.
Thank you so much, Arun, for having me today. Happy to be here.
Thanks, Manish. Thanks for taking the time out, your busy schedule. I know these are times when the markets, keep you on your toes, keeps everyone on their toes. One has to be very watchful. Markets are very volatile. Just to put the context in place, would just like to know from you, certain things which are there on everyone's top of everyone's mind right now is the geopolitical situation, the geoeconomic situation, which everyone has started referring to lately. What is your assessment of this whole build-up out there in terms of the three things which, seems to be, the world is bouncing around between these three walls? Number one is the geopolitical situation, with the tensions in Iran and what happened in Latin America. And then, the tariff issue, which is there. That's another thing which is, impacting markets around the world. And of course, the third and most important thing, sorry, I had to cut the phone. The third and most important thing out there is specific to India. How do you see India among these markets play out? So if you can share your views on the macros.
Yeah. So as far as our domestic economy is concerned, I think things have actually been far better than what most people would have envisaged it to be at the beginning of the year, at the beginning of this current financial year. And we've managed to actually do fairly well on all the counts. You start off with the government in terms of trying to push consumption last year. They gave tax breaks, which were very helpful. And then you had RBI, which cut rates by almost 125 basis points. Both of these indirect measures really helped the average household deleverage their balance sheets a lot. If you look at the leverage as a percentage of overall household budgets, had really shot up in the last 4 or 5 years quite dramatically. And then you had the icing on the cake, which was GST, the rate cuts, which really did help, pick up urban consumption, discretionary consumption a lot. So that was one part of it. I think from a second perspective, this year's budget, people really had no hopes on it because the wiggle room was very limited as far as fiscal deficit and the fiscal discipline was concerned. But I think they did remarkably well in terms of curtailing the revenue expenditure, in terms of building out the budget from a next year's perspective. Looks fairly realistic. And from that perspective, not only is the debt overall in control, not only is the fiscal deficit going to continue to remain on track, but investments from central government's perspective come back in a big way. So when you look at the defense expenditure, when you look at the overall central government capex, I think that comes back in a big way. So I think that was a win-win positive from both the perspectives. After a very long time, we've seen sustained containment as far as inflation is concerned, which again was a fairly proactive thing. So as far as overall picture from a macroeconomic perspective is concerned, I think things are looking very good now, and that is starting to reflect in the Q3 numbers as well. When you look at this current quarter's result, before we entered into this result, for a period of almost close to 4, maybe 5 quarters, we've been seeing a earnings downgrade cycle coming through quarter after quarter, every single quarter, right? So things have not really been all that great. We were expecting about 12, 13% earnings growth at the beginning of every single quarter. We ended up delivering anywhere between 5 to 7% at the end of it. So there was a continuous cycle of downgrade, and hence you see from almost August, September of 24 to now, the markets have actually remained flattish. All the bounce back, pull backs, pull downs, everything being put together, we are by and large flat over a good 18 odd month period time perspective. But that again seems to be behind us. When you look at the bigger sectors, for example, autos, when you look at public sector banks, when you look at NBFCs, the results have actually been quite good. When you look at the overall perspective, BSE 500, the mid caps and the small caps, I think again the numbers have been very, very good for the first time. So definitely one big major concern with the market typically had as far as domestic economy is concerned was essentially the earnings cut cycle. I think that's by and large behind us. I do expect Q4 to be better than Q3, and then the first half of next financial year to be even better than Q4. So we are now going to be in a gradual earnings pickup and probably an earnings upgrade cycle that you have. And from that perspective, at less than 20 times on a 1 year forward perspective, market valuations are also reasonably poised at this juncture. So domestic, I think risk reward remains very favorable. But then, the first two questions which you asked, which really are a concern area at this moment, which is the global geopolitical and then the global economic, parlays, the way they are kind of moving around. Now, as far as geopolitics is concerned, that doesn't really bother me all that much, right? We've seen far more worse in the last 5, 6 years. And probably ours is one of the very few economies which has come out insulated, which has come out largely unscathed from all the turmoil we've seen. The COVID period, the way shipping rates went up globally, and the inflation in shipping and freight industry, that the way we saw that twice over in the first wave and the second wave. Then you had the Russia-Ukraine war situation, which kind of led to a very large-scale disruption in Europe and the other economies. There was a fear that oil prices would shoot up. And I think we were able to manage to navigate pretty much across the board everything. And I don't really see the US and the Middle East tension in the way they stand today to be a very prolonged one. My personal belief is that had it had to happen, I think it would have happened by now. You don't push your naval ships, over there and then kind of wait for as long a period as you have been waiting for. What bothers me is the uncertainty in and around the tariff situation, which continues to prevail. And I'm specifically referring to the India-US thing. Now, we had been negotiating for almost 12 months, starting of January last year to January this year. We were probably the worst hit amongst all the emerging markets as far as tariff was concerned. We went to 50%. Some of the largest sectors that are export oriented, specifically on the merchandise front, for example, textiles, auto parts, were very badly hit. But just when we saw the light at the end of the tunnel and the trade agreement being signed at 18%, and people started rejoicing, you had the Supreme Court decision come through. And consequent to that, we've kind of gone back to the drawing board as we were before that, where we now have 15% duty across the board on all the countries globally. You have the situation being at a flashpoint between Europe, UK, and USA, where both Europe and UK are now going back and having a rethink as far as their trade agreements with the US was concerned. So they do not want to ratify that anymore because they probably are going to be the worst hit. But as things stand today, I think the uncertainty notwithstanding, I think India is still going to be much better off as compared to what we were about 3 or 5, 6 months back. In a worst case scenario, you're looking at 15 to 18% sort of a duty structure. And amongst all the sectors that you see when you compare yourselves with China, or when you compare yourselves with Bangladesh and Vietnam and Indonesia and all these countries, I think what we realize is that we are probably going to be amongst the better ones on all the fronts. And then the icing on the whole cake is a UK and India trade agreement and the EU and the India trade agreement, which again opens a door for a lot of sectors. And especially at the higher end of the bracket, at the discretionary consumption, it brings down the inflation even more over the course of next 12 months or thereabouts. So I think things are looking good where I'm standing today. And my very strong belief, Arun, is that when you look at equities, you have to remember as an investor two things. One is that a large part of the wealth creation. Now, if you are a trader, it's absolutely fine and okay. But if you really have the aim of creating wealth in equities and substantial amount of wealth in equities, it's a long wait game. It's a 3, 5, 10 year period game. You know, the longer you leave it untouched, the better it is. And from that perspective, it needs a lot of patience. And people who have historically made money in equities globally, if you look at an obscene and vast amount of money people who have made, are the ones who have actually bought and held. And they have bought at a time when everybody was selling, and they've sold when everybody was buying. So the idea should not be to panic. The idea should not be to look at what everybody around you is doing. But my sense here is that if you're not going to buy banks today, especially in the large cap segment, right? If you're not going to be buying banks today, if you're not going to be buying auto companies today, look at IT also for an example. All the noise around AI notwithstanding, these guys have all gone to pre-COVID valuations now. Some of them are trying to test all-time low valuation multiples, even in the large cap space. So my sense here is that if you're not going to be buying these companies today, then when are you ever going to be buying it?
Correct. I absolutely agree with you, Manish, on that. Is that the best time to buy is when everybody else is panicking, and that's where the real money is made in the market. The real wealth is created, rather. The real long-term wealth is created, when there is panic in the market, and you approach it with a calm and level-headed manner. So, and I absolutely agree with you on that. But the one thing that has been plaguing the Indian markets at all times, as far as I can remember, is FIIs.
Yeah.
We've never understood these creatures, and whenever we performed well, they've left us.
Yes.
And they've been around for a time now, but over the last decade or so, if you see, most of the years they've been sellers.
Yes.
Right. And last year also, vast amount of money has gone out as the FIIs continued selling. So to the question of FIIs, do you think there is any fear in terms of these institutions with regard to India, despite putting up a 7% GDP growth, and Q3 also appearing to buck the trend, and maybe we are seeing an earnings uptick, and in some cases the earnings has been a surprise. So when you look at that, and when you see that small caps have also delivered decent amount of earnings growth this quarter, do you see FIIs coming back in the year ahead in a big way?
Not really. I don't think we should work with that assumption in mind, given the track record you very rightly said. See, if you look at the FIIs and their participation in the Indian market for the last, 5 or 6 years now, since the COVID days, by and large, we've been negative year after year, every single year. In fact, I was looking at a data where you look at the average FII holding in the Indian markets, they've been pruning it down by 1 percentage points every year for 4 years now, right? So we've come down to almost a decadal low as far as 3 year rolling FII numbers are concerned, and as far as the holding in FIIs in Indian stock markets are concerned. So historically, this would have been a major cause of concern. But what gives me a lot of solace is that when you look at a year like, for example, 2022 also, when the whole world was undergoing a turmoil, and when the whole Russia-Ukraine war was kind of unfolding, and FIIs pulled out money, which in absolute terms was actually higher than what they had pulled out in the GFC year also, right? And from that perspective, that was the year when, I think, if I remember it correctly, Nifty delivered a plus 4% return. And we were amongst one of the only major global markets, equity markets in the world, which had delivered a positive return that year. So I think given this financialization of assets that has happened, given the way the culture of investments, particularly in equity, has come in a big way, and you look at the SIP numbers, right? I still remember in 2017, just after demonetization, the average monthly SIP numbers used to be 5 to 6,000 crores a month. And you look at the numbers today, so we've gone a 5x of that number in less than 10 years time frame. So the amount of liquidity that comes through, despite all the DII money being pumped into the equity markets and the amount of buying that they have done, they still continue to, MFs on an average, still continue to sit on 1 to 1.5 lakh crores of cash pile even today. So as long as DII liquidity sustains, and I think these this will sustain because SIP money typically tends to be very sticky in nature. I don't think that should be a major worry point. And I think the second answer over here is that, see, FIA behavior has been determined on account of two things. From a very short-term perspective, intermittently, the valuations in China, for example, the Chinese market have been very, very lucrative, very, very mouth-watering. So a large part of money has been diverted towards that cause. And we've seen that at least, what if I remember it correctly, since the COVID days to today, at least three times we've seen that trade play out, where the short-term China trade has kind of played out. Whenever the Chinese market multiple tends to go below 10x, FIs tend to pump in money over there. And then the second thing is the US markets, right? And that has something, the US economy has been something that has defied logic and has been pretty much ununderstandable for everybody. You look at the way inflation has behaved in the last 5, 6 years and the way rate increases have happened, and yet the economic growth and the consumer demand in the way that continues to hold up. And you look at the kind of returns people have made on Nasdaq and everything, and then plus the bond yields, right? At a certain point of time, they were upwards of 5% as well. So that money continues to get diverted over there as well. So I think base case investors would do well with the assumption that it is predominantly going to be DII liquidity that is going to drive the Indian markets. If FIIs come through, I think that will be icing on the cake. It will be an added bonus, but at this moment, I wouldn't build that in.
Okay, so that's a very heartening thing from you that, we are not dependent on the FIIs anymore. So all this fear about, in the last 1 week, whether they are back or they are not, 1,000 crores, even if you buy at 20 crores FIIs buy, they'll say, okay, we've seen FII money come in, but that's loose change. But yeah, so what you're saying is we are no longer so dependent on the FIIs. We are quite self-sufficient. Even if the FIIs don't come back, we are quite capable of, supporting the markets on our own, given the fact that India is so low on equity exposure, and with financialization, there's a long way that we have ahead of us. Point taken. That seems very logical. But tell me one thing, Manish. In all of this, there is one thing which is important to note. That's the dollar.
Yeah.
If there is no inflow or influx of dollar coming in, what do you think will be the direction the rupee takes? We're already at 91, thereabouts. We're anywhere between 90 and 91 right now. And it's not been a very great year for the rupee when we look back. And when we look ahead, with you being doubtful about the FII money coming in, dollar inflows may not be so great again. And also, if India agrees with the US on majority of the counts as far as the trade deal is concerned, we'll end up importing a lot from there. And would that mean, again, more dollars?
Yeah.
Yeah. And what do we do in that situation? Where do you think the rupee headed? And how will that affect us as an economy? Because we're talking about one industry which is very important over here, and that is the IT industry, which is so heavily dependent on exports. So how do you think the rupee is going to shape up and impact us as an economy in 2026?
So, Arun, in all this, you've raised one very pertinent point, which is that if we agree to everything that the trade deal, and there's nothing concrete that actually ever came out. All we heard was news clippings and press reports and all of that. But yes, there was an agreement which comes to my mind as well, where we had agreed to import a substantial amount of goods, merchandises from US, and that number was very staggering. It was very shocking to me because I can't really think of what is it that we are going to import from US. What exactly, other than agro commodities, what is it that US can import to us which we are going to benefit out of? It beats me. It defies any logic to it. But what I've observed on the INR is the long part of it and the short part of it. See, in the last 1 year, I think rupee going from 82, 83, 85 to now 91, I think in part it was a little deliberate. And I think RBI was ready and prepared mentally to let the rupee go till 95. Had the trade deal embargo continued to happen, and we would not have signed the trade agreement, or the Supreme Court decision would not have come in, I really suspect that the rupee was actually heading to 95. Now, the point here is that, see, the first 25% duty that the US put actually did not hurt us all that much, because China was still at 34, you were at 25, you were kind of on a relative basis okay. Your export competitiveness was still okay, especially in competing categories like, for example, apparels and garments and all of that. But the next 25% actually hit us very badly. And in order to compensate for that, the only way you could have mitigated that disaster any which ways, even a little bit, was to sacrifice your balance of payment, sacrifice your trade balance, and let the rupee slide in a little bit. To kind of mitigate that impact out as much as you can, right? And that is why we heard, I'm sure you must have also heard, that the REER of rupee was basically 97 in RBI's mind. So they were okay to let it go to 95. But having the trade agreement reached and that being in place, or the duty structure being a little more clear today than what it was a month back or 2 months back, I suspect the rupee is going to be stable from here onwards. I don't see a very wild swing in rupee from here onwards. But having said that, see, if you look at down the whole last 20 years in two parts, which is pre-COVID and post-COVID, what you realize is the swing in USD INR rates on an annual calendar year basis used to be very wild in the pre-COVID days, right? We've seen years where seen rupee appreciate and depreciate both in double digits in consecutive years. So the swing used to be very, very wild. But if you look at the last 5, 6 years, what we've noticed is that there'll be 1 year where there'll be a massive depreciation of rupee, and then 2 years it is stable, and then again it goes, and then it's stable. So last 1 year has been bad, but before that, if you see, for almost a period of 2 years, the rupee was fairly stable at 1.5, 2% sort of a depreciation every single year. So my point is that from an equity investor's perspective, whether you're a domestic investor or whether you're an FII, safe to build in a 2 to 3% annualized sort of a depreciation of rupee every year going forward for the next 5 odd years, 6 years, thereabouts, right? And work with that assumption in mind. If it doesn't play out, it's an added bonus you have, but that's essentially the trajectory you should play out for. But given the shape of our domestic economy, given the way interest rates are moving, given the way US economy is behaving and the trade agreement and all of that in mind, and plus the de-dollarization impact of it as well, right? We've seen probably the worst of it behind now, where a large part of gold buying happened from Chinese central banks and Indian central banks. India, if I'm not mistaken, if my numbers are not wrong, we've seen almost 100 to 125 $1 billion worth of our FX reserve being swapped from dollar into gold, right? I think all of that, by and large, being behind us, I would expect rupee to remain stable. So that's not going to be a major worry point for me.
Perfect. That also allays a lot of fears in people's mind, because the investors that we keep talking to, the most commonly asked questions, one of the most commonly asked questions, where do you see the rupee headed? So you say that the rupee is going to be stable at the current levels, not depreciate too much from here. So that's one of the reasons why the FIIs have been selling, is that the rupee constantly depreciates, so they don't actually make any money. That's one of the things. But another
Your dollar
thing
returns
which
get hit a lot.
Yeah. And another thing which is, which they keep a watch over is the earnings. I mean, India's never, come up with a good set of earnings numbers. But what do you see earnings like now, with 2 quarters behind us, third quarter looking better? Do you think they're on corporate earnings? Do you think we're around the curve? We're done with it? With the downgrades on earnings, are you going to see any upgrades happen now, or what is your view on earnings going forward? And where do you see these earnings kick in? Which pockets do you see that coming?
Yeah. So I'm a little optimistic. I think from here onwards, you will see earnings growth starting to pick up a little bit. And I think this year, Q4, like I said, is going to be marginally better than Q3. But you should expect, on an average, when you look at Nifty, I'll be very surprised if we deliver anything less than 15% sort of earnings growth in the first half next year, right? And post that, it kind of depends on how the festive season is, and what do you make out of the RBI policy, plus the budget, and all of that factors kind of start coming into the picture. But the visibility I have, at least for now, is for the next 3 quarters, and I'm very, very optimistic that you'll continuously see earnings picking up quarter after every quarter for the next 3 quarters or thereabouts. And sectors where I'm very, very hopeful of a pickup happening, I think, is banks is one sector which I'm very, very optimistic on. Amongst the larger banks, if you see, and NBFCs, good quality NBFCs, if you see, we've definitely seen a significant amount of credit growth pickup happening. And that, along with the asset quality kind of remaining intact, the concerns which had emerged out last year, I think you are in a good shape, right? The only incremental challenge as far as banking sector or the stocks that kind of remain is the LDR ratio. So deposit mobilization kind of is probably the only challenge on the horizon that you see. But other than that, if you look at the valuations across the board on a 10-year basis, I think you'll figure out that everybody is either at long-term average or below that. So there is a lot of value in there. And even if you deliver something like 17, 18% sort of a PPOP growth, including the fee income, I think at anywhere ranging from 1.2 to 2.2 times price to book, there is a lot of value over there. So banks is something that I'm definitely going to be looking at. And then the other interesting sector for me is going to be autos, right? Again, when you look at it across the board, I think we have definitely seen a demand pickup which has happened, and one of the sectors which is going to be one of the biggest beneficiaries of the FTA between India and Europe and UK is going to be autos. So from a 2-year perspective, I'm going to keep that in mind as well. So I'm going to be buying autos. Then, if you look at the domestic consumption plays, again, are something that are going to be very, very interesting. But the other way of playing that could potentially be all your EMS companies, which have been beaten down a lot in the last 12 months or thereabout. They're all down like, 50, 60%. Some of these stocks are down. So valuations have come down very dramatically, while earnings growth have actually not. So there is a good time to bottom fish those. Then there are your traditional sectors that you've always looked at, for example, hotels, in pocket, some of these hospitals, power utility companies where you're seeing exponential growth, especially in the T&D segments. So I'm going to be optimistic on all these sectors. And defense, again, I'll probably start looking at it very seriously now.
So excellent. That pretty much covers majority of the sectors that we've seen an up move in the recent past. So I guess we agree on that. Banks, NBFCs, autos, hotels, hospitality, as well as hospitals, all of those look good from the earnings perspective. That brings me to the question which we are to address today. Manish, you very effectively addressed the risks that the world is facing, the geopolitical level, and the resilience which India has shown in terms of its growth. The numbers are good. I think we quite a lot of dependence of the FIIs off, and we are pretty much self-sustaining. So a negative situation around the world, and India seems to be a safe haven. And given this scenario, as a fund manager, how does one generate alpha in this situation? So what would Manish Jain advise my investors to do? How do you think they should generate alpha in these kind of volatile times?
I think the best thing to do is to have a multi-cap portfolio, which will have representation of large, mid, and small, all three at this juncture in the way I'm going to construct a portfolio, and all three for different reasons. Large caps, I'm going to predominantly buy because some of these large cap stocks have started to get into a value zone. And you've seen things bottoming out, right, over there, which sectors typically you can talk about are IT, banks, etc., right, which have all come down to a zone where it looks like they are good value. So that will give you some kind of a protection, solace, some moderate return in your portfolio over the next 12 months. And then I'll have a very decent representation from mid-cap stocks, predominantly for a growth perspective. And we've seen that in the last couple of years that mid-cap companies have actually outpaced the growth across the spectrum as compared to large also and small also. And that's typically the reason why they're trading at a premium the way they are on a sustained basis for 2 years now. Small cap is a segment that I'll buy, but that's again going to be a very bottom-up driven strategy. It's going to be a very stock-specific strategy. It's not going to be a top-down strategy. I'm going to look at ideas which are under-penetrated, ideas which are undervalued at this juncture, and my portfolio construction time frame is going to be 2 years. So I'm going to hold on to that from a 2-year perspective, and I think it's a good time to buy today. Like I said, buy when everybody's selling and sell when everybody's buying. More often than not, you'll make money. That's point number one. And point number two is that people often forget that investment is actually much simpler. Equity investment is much simpler than what most people give it credit for. There are two things that you need to remember. If your time frame is correct, if you're looking at 5-year plus time frame, and if you're picking up the right kind of quality of stock, and if you're sure about the growth prospects of it, then actually none of these numbers like valuations and P multiple and all of that matter, because even you look at Nifty and look at the last 20 years chart. At any given point of time, if you would have picked Nifty up at its 52-week high and held it for 5 years, you would have made double-digit CAGR returns, right? That's essentially the bottom line which the market is saying. So time in the market is actually far more important than timing the market. That's one thing that you got to remember. And second is that do a very top-down sort of an analysis where you need to be sure about corporate governance, you need to be sure about the execution capability of the management, and the ability of the management to leverage up the growth that the sector is promising you. And as long as you get those three things right, again, from a 5-year perspective, you'll make money. So it's actually much simpler. It needs is a little bit of guts and a little bit of common sense. You bring them both together, you have winner at hand.
Okay, so you are making it sound so simple to generate alpha, but I'm sure it's easier said than done. But delving a little deeper into the mind of Manish Jain and this philosophy, your investment philosophy in the PMS that you run revolves around the edge model which you follow, the
Yes.
EEGE edge model which you follow.
Yes.
And
Yes.
do you think investors can draw a little bit of idea from that as to how they can structure their thinking around how
Yes.
to generate alpha in tough times? So can you draw a connect between the model and the challenge, which is generating alpha?
Absolutely. And the edge philosophy is, again, something which has been very time tested. Arun, you know it, I know it, that, in Centrum, we've been living and breathing by this philosophy for almost 12 plus years now. And we stick to it across the time frames, across market cycles, right? And it's actually very simple to understand. See, the first E in the edge framework is nothing but the quality of the earnings, right? So earnings is the first E. And what are we looking at? Companies that have track record of growing their profitability or operating profit, as we call it, consistently in double digits over a long period of time. So that gives you some kind of a comfort on the ability of the management to navigate through tough times, competitive times, and still continue to grow the company year on year, every single year over a long period of time. And you're looking at 15% plus sort of an ROCE number. Why 15%? But typically because the cost of capital for any decent or half decent company also is going to be lower than 15%, right? God forbid if you're investing in a company that has ROC, the cost of capital of more than 15%. So if your ROC is 15% and if your cost of capital is lower than that, your economic value added is positive. So that essentially means that the company is not just growing, but also creating wealth for all its stakeholders in question over there. That, if you combine with leverage, which should be lower than 1.5 to 2 times, you have got a winner at hand, a company which has the demonstrated track record of delivering in the past. Then you come to the D part of it, which is deep dive research, which is basically sizing up the opportunity, looking at the competitive advantage or moat as far as the company is concerned, doing some channel checks, looking at the ability of the company to scale the business up over the next 5 years, 10 years. Like I said, essentially what you're trying to do, condensed down into one single sentence in very simple terms, is to look at the capability of the company to leverage the promise that the industry holds. G is probably one of the most important things, which is corporate governance. Not just in this company, which you are trying to look at, but in the group companies across the board, in the private space that the promoters are, how is their reputation? And that becomes a single most important point, because when corporate governance issues blow up, investors lose money in a matter of hours and minutes and not days and weeks. And last is execution. So execution is more important because a lot of times retail investors tend to have a habit of holding on to their losses. We tend to book our profits very quickly, but we hold on to our losses for a very, very long period of time. And we've seen that across industries where companies have faltered on execution. So you give it 2 quarters time. If the company is not able to deliver, if the reason differs quarter to quarter, every quarter for the 2 quarters in consecution, then there is an execution problem in that business or in that company. And you're better to just cut your losses and get out of it. So that is the edge framework, right? Basically earnings, deep dive research, corporate governance, and execution track record. And if you live with this, and if you have a 2 year, maybe 3 year sort of a time frame of investment, then you will draw very steady returns out across market cycles and across turbulent and good times. It wouldn't matter.
Wonderful. That's very well put. And I hope my investors can steal a few ideas out of it and maybe implement that would give them some edge over others in the market. So thanks for that explanation. And Manish, I'll just break here and ask all the viewers, those who are listening into this, if you have any questions, please put your questions in the Q&A, or you may raise your hand, and we'll take up any question that's pertinent to the conversation, the one very interesting conversation we're having with Manish Jain. So Manish, I'll ask you a set of questions for which I would request you to, briefly give an answer, and where investors can just take this up and start, implementing from tomorrow. The first question I had for you on this is, we've seen Indian markets underperform grossly last year as compared to global markets, other emerging markets, even EM peers did better than us, even very bad economies did better than us. But is 2026 going to be the year of Indian equities?
I think so, because we've seen most of the domestic issues that we had being out of the way. The earnings growth is looking very, very strong. I'll be very surprised if investors don't make 15% plus sort of a return this year just by being invested in the indices. If Nifty is not between 29 to 30,000 by the end of this year, I'll be very, very surprised. So this is going to be the year for Indian equities for sure.
Great. Between large, mid, and small caps, which segment do you think will do well in 2026 and why?
From a value investor's perspective, I think it'll be large caps, which I'm going to be, gravitating towards. But if you're a growth investor and do not mind taking some couple of more months of volatility in your stride, and if you have that appetite, then I will gravitate more towards mid and small caps. And remember, the alpha over a 12-month period in mid and small caps is going to be larger than large caps, but large caps typically will give you value and stability.
Great. So given this view, should an investor opt for a diversified portfolio or a concentrated one for 2026?
I think anywhere between 20 to 25 stocks is what my bet would be for portfolio construction. That's just right, the optimal amount. You're not over diversified and you're not over concentrated. It's just the right amount where every single stock movement will impact the portfolio returns, but you're not so leveraged on a single stock that movement is going to derail the entirety of your portfolio. So I'll pick about 5, maybe 6 sectors and about 20 or 22, 24 stocks.
Excellent. 5 sectors and 20 to 24 stocks. That's the kind of diversification. Anything more than that will be dilutive on returns. Manish Jain's top 3 sectors for 2026.
So my top 3 sectors, number 1 would be banks, number 2 would be autos, number 3, which is going to be very controversial and very counterintuitive in the large cap space, is going to be IT actually.
Which sectors to avoid in 2026?
For sure, I would continue to avoid FMCG. That is one sector which I'll probably not still bet my money on. Looking at 4, maybe 5% sort of growth over there, and you're paying still 50 times plus multiples over there. So that's something that I'll definitely try and avoid. And some of these ideas in the small cap space that used to hold a lot of promise but have kind of delivered phenomenal returns in the last 1 odd years out, where valuations have kind of become very expensive. I think that again is going to be sector where I'm going to avoid. For example, retail, where valuations look very, very rich to me. I'd probably kind of try and avoid that as well.
Okay. So I've started getting some questions over here from our viewers.
Yeah.
And one of the questions I have is a question, in fact, which I had in my mind. One of my sectors, which has been my favorite sector for some time now, but valuations are quite rich. So I'd like to have your views on that. Someone is asking here, what is your view in mid-cap and small-cap space in mid-cap and small-cap companies in the defense sector? And So overall, what's your view? Without naming stocks, what do you think could be the view on the sector?
Yeah. So no, I like defense. Like I said, defense is going to be something that I'm going to be looking at now. The sector obviously has gone through its ups and downs in the last 12 months or thereabouts. This is a sector that used to be a favorite for 2+ years and then kind of went out of favor, moved sideways. We've seen everything in the last 12 months with this sector. Uh, but I think it looks good where it is today. I think it's a time to top up. We, in fact, have been, incrementally buying more of defense stocks in the last 2 odd months or thereabouts in both our DPMS and NDPMS strategies. So defense is something that we definitely like.
Another view which people want is on cement and pharma. Pharma has been an underdog, not exactly what we thought it would be. Like last year was a little subdued, but I think this quarter some pharma companies have delivered some bit of surprises over there. So cement and pharma, what's your view on these two sectors?
No, so cement, I'm positive. Cement, I think it's a good time to buy, especially amongst the larger pack. If you see for the last 12 months, some of these stocks have actually either remained flat or underperformed massively. So I think cement, from that perspective, is a good time to buy. Pharma, probably I'll wait a little bit, right? Because last year they underperformed a lot, but I think the problem over there essentially was that people were scared a lot whether pharma will get included in the tariff pack, not get included in the tariff pack, and how will it behave was kind of a little bit of a worry point for them. I think that part is a little settled. But even if I have to look at pharma today, I'll probably look at domestic pharma more than global pharma.
Okay, great. Manish, just moving off the sectors a little bit, one thing which I ask all my guests on my webinars is what uh, you know what makes Manish Jain successful? What are the top three qualities that you have in you? This is, of course, for viewers to kind of try and inculcate those qualities a little bit in themselves. What makes Manish a great stock picker? What are the top three qualities which you think investors should have if they should be good stock pickers?
So three things, very interesting question. First would be to have patience and stay put for a long-term perspective. Don't get swayed by short-term movement. Don't fall into the trap of greed and fear. Second thing would be to be very quality conscious. I think that's very, very important. A lot of times you hear redemption stories, management change stories, turnaround stories. I'm not saying don't buy them, but be very, very careful and very skeptical about that. Probably 1 out of 10 will turn out to be true, 9 will be wrong. So quality consciousness is very important. And third, and the most important point is to have a long-term investment approach in mind where your worldview is more top-down rather than bottom-up. Multiples are important. ROC, ROEs, PE multiples, price-to-book multiples are all important. But quality of the management, execution track record, the opportunity size, the ability of the company to leverage that opportunity size, I think are far more important than anything.
Okay, so patience is the most important thing, and I guess that's where all our clients should be. That's the one quality which they should be looking at, because here you hear a lot of noise in the market, and it's very difficult to listen to the music behind the noise. How do you cut out the noise? So that's my question to you, Manish. How does one cut out noise? Because if you look at the events going on around us, of course tariffs is there. That's a scepter that's hanging over our head. The other big thing is all the sound we are hearing about AI.
Yeah.
Okay, that's I don't know whether that's music or noise. We really don't know what's
Yeah.
fact, what's not. That's one area where I think if you just turn on the television set or you open the pages of a newspaper or any magazine, that's all they're talking about is AI and what Anthropic has done. So
Yeah.
I'd like to know your views on number one is what do you think of the valuations of the IT sector in the US, and the kind of investments that have been made in AI. It's staggering. I mean, much of the investment is bigger than many small nations have GDPs. So
Yeah.
those kind of that kind of money being pumped into AI, and so you're talking about a situation where most large companies, you feel that they are over-investing in AI. And on the other hand, a few weeks later, you have an Anthropic coming up and saying, look, we can replace bulk of the workforce in many sectors because we have our agentic AI in place. So, that again says that, okay, the investment is perhaps worth it, that you do have agentic AI solutions coming up. So it's sort of flip-flopping between the two now. So where do you think the AI, situation is headed? Do you think one should be afraid of it, or do you think Indian AI is quite qualified and capable of taking on this challenge, and maybe in the next 1 year you'll find our IT companies coming out winners? So where do you think this whole thing is headed?
So, it's a very good question. And Arun, you've lived through it, I've lived through it. In the last 20, 25, 30 years, we've seen enough turmoil at different points of time. On an average, one every 8, 9 years, global scale change and turmoil that threatens the world order, and how we live through it, right? You look at the emerging market currency crisis, and then you had the global financial crisis, and then you had the India-specific demonetization event, and then you had the COVID phenomena, you had the Russia-Ukraine war situation. So we've had different events that you lived through. And what you realize 2 years down the line, or maybe a year down the line, is that, again, the fear always is far more exaggerated than what the eventual reality is. When I still remember GFC started, at that point of time, unfortunately or fortunately, I was actually working for Lehman Brothers. So we lived through the whole crisis and saw it unfolding much more closely than what the whole world did. And at that point of time, I remember people talking in terms of the global investment banking industry shutting down. There was a conjecture that whether Citibank would survive or not at that point of time. And that was a fear, because of the subprime mortgage crisis that you had at that point of time. And that's the thought process people had. When you look at Titan and jewelry companies, for example, in 2016, when demonetization happened, it looked like as if these jewelry companies would come to an end and the whole industry will shut down. I think what happens is, to the investor's mind, is that the fear is always far greater than what the eventual reality comes out to be. And that's essentially what I mean when you say that you don't need to fall into the trap of greed and fear. Keep your eyes and ears open, evaluate the situation a little dispassionately, and then take your decision, a little bravely. I still remember in 2020 March, that last week of March, more people sold equity than they bought. When Nifty had hit 8,000, at that point of time, also people were continuing to sell it. 8,000 Nifty. And if you remember the valuations that it was trading at, and people were still selling, saying that it will go to 7,000. The point is, Nifty doubled in the next 6 months. So the point is, you don't fall into this trap. Yes, AI will fall in place, much like EVs. It will be an integral part of everybody's life. You cannot escape it. At some point of time, it will come through into everybody's life in every single domain. In part, in your and my life, it has already replaced Google. So now you don't Google anymore, you all use chat GPTs, right? And we all do it. But does it mean that the global IT services industry is going to shut down? Because these valuation multiples are absurd. They're bordering on, at days there was when some of these larger IT companies were trading at 17 times valuation, when the life low multiple, entirety of it, has been about 14 times, or the 14 and a half times thereabout. So they were that low. Now, my point is, a company is not going to go under liquidation. It's not going to shut down. The business model is still very sound. So if you are confident of the management's ability to veer through this crisis, which they have seen in history also, then actually it's a good time to buy rather than panic. Because had it been anything material, these companies are very proactive in coming down and telling their own story much before the market would have demanded them of telling.
Right. So that's very heartening to know there that these IT companies have still got a lot of juice left in them. And yeah, you're right. They will adapt. They will adopt AI, and they will adapt. So I agree with you that this is perhaps a level where one can start looking at that sector again, because valuations appear to be getting compelling. But one thing we need to just watch out for is, do their business models shift in the right direction and at the right speed to catch up with what is actually required. And if they manage to do that transition, I think I agree with you that these companies are have some runway ahead of them. And you've been talking about banks, Manish. So I have a question from one of our audience here who wants to know, private sector large cap banks, do they have any more upside in valuations, or are they in do they have any more room for upside?
I think so. I think so. Some of these larger private sector banks, for example, if you see, are trading at almost a 10-year low as far as valuation multiple is concerned. And if you look at some of these larger PSU banks, then they are trading very close to their, ROA, right? Almost at their ROA multiple. So there's no premium that you're actually giving to them. And the funny part is that in the last couple of years, where the NBFC, particularly the MFI sector, has gone through asset quality challenges, despite the way the retail loan book for all these banks have grown out in the last 4 or 5 years, and the kind of size it has attained, we've actually not seen any major asset quality issues that have emerged out at this juncture. So the only issue basically in banks, and the reason why they've underperformed in the last year or so, is basically that the credit growth at the economy level has kind of gotten hit a little bit, primarily or partially maybe due to RBI's clampdown and them controlling the whole retail loan book growth in order to try and control the asset quality proactively. But from that perspective, like I said, if you are looking at 50% plus sort of a PPOP growth, and if you have a company that is trading at anywhere between 1.2 to 2.2 or kind of price to book, and delivering in and around 15% sort of an ROE and 1% plus ROA, I think it's a good time to actually look at these stocks and buy. Yes, there is enough room for these stocks to perform and give you substantial returns. Why a 1.2 will not go to 1.4 or 1.6 is beyond me.
And one quick question from my end again. So, Manish, between growth and value, what do you think will play out in 2026? And yeah.
So we've seen, 24 we saw growth playing out, 25 we saw value playing out. I think 26 is going to be the year where you need to have a little bit of this and that. It's not either or. So I'll opt for a portfolio that will have a balance between value stocks and growth stocks. So I'll pick some mid and small caps, but I'll also keep some bit of large caps over there.
So what is Manish Jain at heart? Is he a growth investor or a value investor? How would you rate?
I'm a growth investor.
So you would be a growth investor, but you think 2026 is a time when maybe you should moderate your expectations a little and look more for valuation?
Yeah.
Stocks that
and
are
hence try and balance it out rather than go all hog out on growth. Absolutely.
So great. So that also reflects in your portfolio, whatever I have seen of it. It is a good blend of both growth and value. One sector which we've seen really taking a hit in 2025, along with IT stocks, was realty.
Yes.
That was among the major losers. I mean, it was the second biggest loser of 2025. What do you think about the realty sector after the last 1 year? Do you think there's any scope of revival there, or you are looking at it continuing its underperformance?
No, I don't think there's anything in the near term that is going to make me a buyer in real estate stocks. So at some point of time, there used to be about 18% sort of a weight in my portfolio in real estate. Today, it's closer to 6%. And I don't intend to buy anything in real estate anytime soon. So no.
One sector which I really wanted to pick your brains on, Manish, is the capital market segment. That's something that has really been, there are a few unlisted players which are just about getting listed. There is a lot of talk about, curtailing the F&O part of it, not letting it get out of hand. And so, it's a good place to be in. But again, it's also a place which I'm worried about. I'm not sure what the next year or so looks, in terms of this segment. And it's also a very diversified segment. You've got the exchanges there. You've got the depositories there. And then you've got the enablers there, like the registrars. So it's a very diversified area, but at the same time, it looks very exciting. But is it? What's your view on that?
No, in fact, in the last couple of weeks, we've cut our exposure in these stocks, some of these that you kind of mentioned. We've actually halved our exposure over there. The rest half, we are going to wait and see how the price movements are. But the way I look at it is that these stocks have done really well in the last 6 odd months or thereabouts, and we've made good money on them, upwards of 25% plus in some of these stocks. So it's a good time to book profits out. So whatever money we had made, we have kind of taken out. Now we're waiting on the sidelines to see how the other half we're going to play out in the next month and a half or thereabouts.
All right, that's also a part of the way I look at it is quite similar to yours. But what about exchanges? You have one waiting to be listed. You've got one which is already trying to compete. FNO restrictions in place. Exchanges are any place where you think there is money to be made within that segment? Between
No,
exchanges
even
and asset management companies, where do you think an investor should be looking at parking his money?
no, we've pruned down our exposure to exchanges as well, actually, to be honest. So
Okay.
we halved it over there as well. Because see, the point is, uh, the government seems to be very intent on trying to curb the volatility in the market, right? It's not so much about FNO in itself, but it's more about the speculative nature of the product and hence trying to curb down on the volatility in the market, which seems to be the real target area. And from that perspective, we've seen a lot of flip-flop fall back and measures being introduced, taken away, expiry going from daily to weekly, then being proposed to monthly, then again going back to twice a week. We've seen all sorts of things in the last year or thereabouts, and then this one now which comes through, which is obviously going to impact the ability of the brokers to take leverage on and pass it on to their customers. So better to be a little cautious, better to err a little bit on the side of caution, especially given the way these stocks have performed in the last year or so. The valuations being where it is, we've actually taken half the money off the table over there.
Great. So that sort of gives us a very good idea into the way Manish Jain handles investors' money and his advice as to what investors should be looking at and what are the ways and means to generate alpha in tough times. And trust me, these are very tough times, very confusing times. And to be able to maintain a level head and keep the noise out and listen to the music and keep on investing, maintaining patience and balance is key to success. And that's what Manish has been telling us over the last 60 minutes that we've had him on board on this webinar. Several more questions are there to ask, but I guess we just sort of run short of time, and we'd like to take all these questions one-on-one, and maybe we can get back to you all on this. Thank you all viewers for joining, and thanks Manish for the most insightful conversation. And we hope to have you again very soon back on one more of our webinars with some other theme going forward. Thank you so much for your time. And thank you, viewers, and all those who joined. Thanks for taking out time this afternoon. I hope this webinar was useful to all of you. We'd love to have your feedback. Please do drop in your messages. Thank you so much for all your time. Thanks, everyone. Thanks, Manish.
Thank you so much.